Testing. Good evening, everyone. We are so excited to have everyone who's attending here and online as we go into 2022 Dollars and Cents seminars. We have some great lineups on these Wednesdays coming up, and our first person will be Miss Olympia Jackson. She has a wealth of information to give us in regards to business taxes. She has 25 years of experience in the financial industry and 10 years operating her own CPA firm. And she's going to come before us with a lot of information. So make sure that you take out your notes and also come with your questions. If you're online, you can type your questions in the comments and we will read them out. We ask, though, that you ask questions pertaining to the section that she's on. Okay, so let's try to stay on the section that she's on, and as she moves through, you can continue to ask your questions in agreement with those. All right? All right, let us welcome Miss Olympia Jackson.
Hello, everyone. So tonight we're going to talk about business taxes. What we've seen operating the CPA firm for the last 10 years is that a lot of business owners, we start up our companies in regards to being a sole proprietor. We just get into business, but we never legitimize our business, or we never report on our business properly. And that really matters when it comes to lending, when it comes to, purchasing a property or other things of that nature. So we want to make sure we cover the basics first, and then we'll go further into the information. So first thing I want to talk about is business structures. This is where the tax impact happens. Also, what we see is that companies, they'll go get an LLC because it's everywhere online. Just go get an LLC, get your EIN number, go set your bank account up, and go ahead and start business. And yes, that's true, but the EIN is very, very important. For those of you that have businesses that set up an EIN already, you'll know that they'll ask you various questions, and those questions are very important as to how the IRS is going to see your business. Okay, so business structures is where the tax impact happens. Choosing the right business entity can potentially save you anywhere from 10 to 40% on your taxes each year. Okay, so it's that important. I always advise those that I know that when you're about to start a business, you need a consultation with the CPA to talk about what your plans are, talk about what your forecasting looks like, talk about where you're headed in that business, and then you can get a tailor-made plan to your particular business. Let's go to the next slide. Most of you, one more slide over, the most common entity types, thank you. So most of you have heard of the most common entity types. The first, which is really not an entity type, but I wanted to include it, is a sole proprietor. So that is our entrepreneur that just starts business and eventually reports everything on their tax return, okay? The next entity type is a limited liability company, an LLC, which many of us know. Okay, so what an LLC does, it gives the individual protection against the company's debts. It separates the company from the individual in that respect. Okay. The next common entity type is a partnership. So you and your colleague get together and you have a joint venture of some sorts and you want to do business together. You may start a partnership. And the last of the most common entity types is a corporation. That is our C Corp, our S Corp. This is also where nonprofits start. They have to start at a corporate level. So if you're interested in starting a nonprofit, the first step is to start a corporation and then move into filing for your 501c3. Okay? Now, another common question that I get from clients is, well, what's the best entity type? Which one is the star of them all? But the real answer to that question is that it all depends upon you and your business and where you're headed. Okay, so somebody may come, for instance, I had a client, I think it was 2020, they came in September, and they grossed over $1 million from September to the end of that year. So their situation is different from somebody else coming and may not, their business may not be as profitable up front. You see what I'm saying? So if somebody comes in, they already have a solidified idea, they already, you know what I'm saying, have a business model that can make them a lot of money, their portfolio and what is set up for them is totally different than someone that comes in and say, okay, I'm ready to start lashes, or I'm ready to start this, that, or the other. You know what I'm saying? So it's tailor-made. And what you're going to have to do as business owners is, while you're having the consultation, is kind of think through what works best for my company at this stage or at this time. So what I want you to do, what we're going to do is we're going to act like you're ready to start your business, okay? So what I want you to do is take your pen, get your paper, let's see, and let's start writing. Okay. All right, so first I want you to draw a diagram, just a line straight across, and 2 lines down, okay? Because we said every setup is not equal to everyone or doesn't fit every business. So in the first column here, I want you to put, let's put LLC, and then let's put SP beside it. The SP means that this is a sole proprietorship. You went to establish an LLC, but you're still operating as a sole proprietor, okay? The next section, let's put LLC, and right above it, just put dash S Corp slash S Corp. That's it. And in the last column, we're going to put C Corp. So as we go throughout our presentation and we go through the different business advantages, I want you to put an X in each one of those columns as it pertains to your choice. For instance, if I give you an advantage and we talk about the specifics of that advantage and it relates to an S corporation and that works for your company, I want you to put an X in that column, okay? I'm going to walk you through it. Before we do, I want to go to the next slide about entity type versus tax classification. So like we said before, when you're starting a business and you're going to get the EIN number from the IRS site, there is a difference when it comes to the LLC. For every other entity type, for the corporation, when you go to online to get your EIN, if it's a C Corp, you're going to put that down. If it's an S Corp, you're going to put that down. But when you get there and you've established an LLC, let's just go with the state of Georgia right now. With the state of Georgia, it's going to ask you, how would you like to be treated for tax purposes? Here is where the 10 to 40% in tax matters. An LLC can have what's called a tax designation of what's called a disregarded member. That means you're operating like a sole proprietor. Okay, you just the money is commingled. Everything is reported on your Schedule C. Okay, it also gives you the option to have a tax designation of a corporation. So an LLC, for tax purposes, can have a corporate designation. Well, what does that mean? That means how a corporation reports, how a corporation handles their financials, everything of how a corporation handles all of their financial transactions. The LLC will do the same, even though it's a LLC, okay? Same case in point, if the LLC chooses the partnership tax designation, there must be a partnership tax return done. The financials must be handled as a partnership will handle their financials. So whatever the LLC mutates into, if you will, that's how it has to operate. That's how it has to report to the IRS. Okay, so now when you initially get your EIN number, you have 2 months and 15 days to make the classification. The best thing to do is make it on the spot, okay? Once that 2-month and 15-day deadline passes, in order to change that classification, you have to file an entity classification form, okay? Now, you only get one of those every 5 years. So you see why it's important that when you go in, you already know how you want to operate, because we're talking about another 5 years before that entity can change classifications. Okay, so that's very, very important, because when you initially sign up for an EIN, that's your pass right there. You get the classification, but then once again, you have to wait another 5 years for that change if you so desire to change. Okay. Another thing that I also want to bring out about the LLC is that what we've also found is that, you know, companies or organizations will go get their EIN as a disregarded member and forget totally about it. And with an LLC, let's go to the board. I think that'll help better. I want you to be able to see it. Okay, so remember we said the business structure is where the tax impact happens. So at this level right here, you're going to report on a Schedule C. The tax on the Schedule C is 15.3% self-employment tax. So if you net $100,000, 15.3% on your net profit. So if your business makes $100,000, how much do you have to pay on that Schedule C? $15,300, okay? Now that's just on the Schedule C. For those of you who have businesses and have reported on the Schedule C before, you notice that it's inside of your personal tax return. Right? So on that schedule, you're going to be taxed at 15.3%, but that $100,000 has to roll to the front of your tax return, which just increased your taxable income. So you also have to pay the marginal tax rate on that $100,000. Now there are some parameters in regards to, there's a self-employment tax credit. It's just a small amount. You know, there are other factors that are involved, but just big picture wise. So not only are you being taxed 15.3%, but you're being taxed a marginal tax rate. Well, what is the marginal tax rate? That is the tax rate that you're assessed based upon your total taxable income. So say I have a business on my Schedule C. Okay, say I net $100,000. Let's say that my husband has a W-2 wage, right, of $100,000. How much is going to be on that front page of the tax return? $200,000 that is going to be subject to the marginal tax rate. So whatever is the taxable income is subject to the marginal tax rate. I can't give you that because that runs on a tax bracket. Okay, so I can give you an example. I can give you an example of it, just not specifics. So for instance, in 2021, the marginal tax rate on $200,000 was 24%. Okay. So you're going to be taxed on $100K at 15.3%, but on $200K, you're going to be taxed on 24%. It's not either or, it's an addition to. You're going to be taxed on a marginal tax rate when you have an LLC that you have not classified as a corporation, S Corp, C Corp, partnership, something other than a disregarded member. This is what's going to happen. And that client that I mentioned to you that came at the end of the year that had gross income of $1 million in those few months, and after he paid $250,000 in payroll taxes, let's just say he ended up with $500,000, he did not do the extra step with the S corporation. So now that $400,000 to $500,000 has to be taxed at 15.3%, and whatever rolls to the top of his tax return with all his other household income is now going to be subject to 24%. If you do a entity classification change, which is possible, it only goes back 6 months. So if we're in February and it goes back 6 months, how many days in December were you a S Corp or something else? What, 15, 20 days? You got a whole year that has to be treated in this fashion. You see what I'm saying? And this really happens a lot. It really, really happens a lot. So I'm gonna let you put a mark at. We're gonna pause for a second. You put a mark there if you like to put a mark there for this column, okay? If that suits your business or you think it is advantageous to your business, okay? Now, what happens then? You went to the state of Georgia, whatever state you're in, and now you have an LLC established. But when you get to the tax designation, you don't choose the disregarded member. You say, IRS, I want you to treat me like I'm an S corporation. Well, what does that do? Okay. Number one, it removes this 15.3%. Hallelujah, amen. That's huge. $15,000 there. I just saved. Okay. But what does it do? For this type of entity, what happens is this S Corp, for either if you establish an S Corp or you do an LLC and get a tax designation as an S Corp, it passes through to your personal tax return, the income does. But it bypasses the self-employment tax, okay? So this particular entity is just subject to the marginal tax rate of 24%, okay? So margin, I'm just going to put 24% for our example. And the last type of entity, mainly, a C Corp, Right now, the C Corp has a 21% flat tax. The Biden administration is proposing a 28% move. So it's going up. Now, what they agree on, but it's moving, okay? They're saying no more, because this is where the major companies land. Oh, y'all get it. Trump knocked it down to the 21, and they're pushing it back up. Now, prior to Trump, I think it went up to 37%, and it was on a tax bracket, so it moved. But I don't care if you make $9,000, 21%. If you make $5 million, 21%. So it's advantageous to those that are higher earners, or, you know what I'm saying, bigger companies, right? And this is going to be advantageous as well to them, especially those that are, you know, in a higher bracket. So in this particular scenario, just with this alone, because the C Corp is kind of fluctuating right now, we don't know until it's final, you know what I'm saying? The middle section is winning for me. I don't know about you yet. Okay. So now that we understand the tax impact happens here, that we can't get by, now we can talk about some business tax deductions that we can take advantage of and what entity they fall into, okay? So this is stable. We can't get around this. If we operating like this is what we're looking at, And a lot of times people, us, we have these huge losses on our return. And I get it. I do. We get it. You know what I'm saying? You get, with that, of course, with that loss, you also get to reduce your income. But once again, is that important for you? Okay. First of all, the loss needs to be substantiated. But even with the loss, is that okay with your scenario over the next 2 years? A lot of times when clients come in, they might be trying to purchase a home. They may be trying to purchase a building, some type of lending, and they need that tax return. Well, you may have on the front page, you may have $100,000. On the Schedule C, you may have $75,000 in a loss. So that means your income is $25,000. Don't nobody want to approve you with $25,000. You know what I'm saying? And they're going to look back. I've heard recently, and this was last year, I had a client where whatever company she found allowed her to just turn in 1 year of returns and then a profit and loss for that current year. But I know a lot of lenders want 2 years. Okay, so you need to be careful there. Tax planning is so essential, because these individuals that have been claiming these losses for 3-4 years, and now the lender wants 2 years, you already in behind. Now you got to wait a whole year and a half or 2 years to move forward. Okay, so that's important. It's like what is going to happen with you in the next 2 years? Well, you know, where are you headed? What do you need? You know what I'm saying? Number one, the first column is not a bad place to be, you know, but it just depends on the stage of your entity, you know, where you're headed and your forecast. So let's talk about the first business tax advantage that we have. The first one is that you can reduce S Corp owners' wages. And we're talking about the middle right here. So you have an S Corp. Either you may have an LLC, tax designation S Corp, or you may have just established an S Corp. With an S Corp, it is mandatory, somebody say mandatory, that the owner is given a salary. Okay? You can't just take money out of the S Corp and say, I'm getting, you know, I'm the owner. No. There are 3 ways you can get money out of an S Corp: a salary, distributions or loan. Okay, what are distributions? Up to your basis, which is up to the amount that you put in. So you got an idea, you established your S corp, you done invested $25,000-$50,000 in your company. You know, you have to fund it. You know, maybe you have to pay payroll up front. You know, all of these things. You have up to that amount to pull out of your company. Okay, before the IRS says, no, that's salary, what you're trying to do is walk around the taxes. That's what's happening. But the benefit here is that you get reduced wages. So you have to pay yourself a reasonable wage, but you can control the wage. Okay, you get to control the wage. And another thing with the S Corp is that there's no double taxation here. Okay, here is double taxation. You're going to be taxed here, and then you're going to be taxed on your payroll, okay? And on the dividends as well. Okay. Any questions about the reduced owner's wages? You get to pay yourself, but you can pay yourself what you need to pay yourself. Now, I'm going to say this. It needs to be reasonable. But if the corporation, which we're going to learn later, can take care of your phone bill, does that need to be in your salary? If it can take care of your car notes, does that need to be in your salary? If it can take care of part of your home office expenses, does it need to be in your salary? It needs to be in your salary when it's time for you to go get approval on something. So if you're 2 months down the line, or you 3 months down the line or something, you know, it depends on what you're trying to get and what you're trying to purchase. But let's just say you could do it with changing your income 2 months ahead of time. Then do that. When you're finished with that major purchase, reduce the salary, right? Because you don't need that when a corporation is handling some things for you. Cell phone expenses. I know this is self-explanatory because all of these can handle cell phone expenses, but let me tell you something about this one. This one can handle the personal and the business use of that cell phone. So if a company issues, this entity type as well as this one, if issues you a cell phone and you use a portion of that for personal, it's covering all of it. This one right here is the percentage of business use. Okay, so if you got a plan, right, now let's be clear, you don't want to be using this at 100%, not right here. If you got one cell phone and you got to put down your business usage, you can't put down 100%. That's impossible. You know what I'm saying? So, but this one will cover personal and company cost. I know a lot of people know about this one, about employing your child. When you have an LLC that's reporting to the Schedule C, let's say you're not in a big income bracket, you're not at 100,000, 200,000, and this entity type works for you, then you can employ your child and you can deduct $12,000 a year in taxable deductions as far as wages are concerned for your child. There's no FICA, which means there's no Social Security or Medicare tax here. Now, if you can do the same here for S Corp. However, the company still has to pay their portion of the taxes. The child isn't charged Social Security, but the company is. And insurance, yes, that's a good one. Is that next? It's next. Insurance premiums. Yeah, it's next. Okay, any questions so far? Okay, so the next one is S Corp covers the owner's health insurance. I got this question from someone. They wanted to know, can the S Corp or a company pay, my company pay for my health care premiums? The answer is yes here. The answer is also yes here. However, you can only deduct that up until your profit. So if you have $1,000 profit And now you say, well, I don't pay my medical bills, or, I paid my health insurance through my company. You can only write off up to $1,000. It can't take you into a loss position. Whereas if your net income here is $1,000, your health insurance premiums for the year is $5,000, you can go into that loss position and use that loss to help you on your return. That makes sense. Okay. Okay, another advantage is that for those of you who may be into rental properties, you know what I'm saying, renting properties, you have the opportunity to sell your home to your S corporation before converting it to a rental property. Okay, let's kind of break this down a little bit. Okay, so when you sell a property, say it's your residence. If I sell my home right now and I make a profit of $300,000, I'm married filing joint, I can exclude up to $500,000 from my income. Anything I make over $500,000, the IRS said we want a piece of that. But I can exclude up to $500,000 married filing joint. If I'm single, I can only exclude up to $250,000. So if my single friends sell their home and they make $300,000, $50,000 of that will be taxed. Okay, so that applies across the board, whether or not you sell it to me, you sell it to your neighbor, or you sell it to your S corporation. Okay, now let's go to this example. You sell it to your S corporation. What's the benefit of that? Well, number one, instead of you just renting the property, you're selling the property, okay? And what can happen is, if that S corporation does not have the full amount of that home cost to pay you, it can pay you in what's called installment payments, okay? Whatever that deal is, right? So if you don't have the money in your S corp to, cover your total home costs, you can do installment. Now, as it relates to any gain that you have over those limits that we just talked about, the $250,000 or the $50,000, then you can also pay that in installments, or you can opt out and pay the IRS the total amount. Okay? Are we good? We clear on that? Okay. So we're still talking about the benefits. So when you sell your property to the S corp, you can increase the depreciable basis in that property, which then means the S corp has a huge deduction. You see what I'm saying? Does that make sense? Make sense? No? You need a little bit more? Right. So in some ways. Okay. She asks, is it just like a vehicle, when you purchase a vehicle, the depreciable value basis in the vehicle? So my response to that was yes and no. It's similar. Okay, so let's take for an example, say my house is worth $200,000. Not worth, but it sells for, so it is worth it, okay? All right, so it's worth $200,000. I sell that home to my S corp, right? It does need to be still, real estate rules still apply, you know what I'm saying? It needs to be, you can't, be selling your home to your corporation for $500,000. You know what I'm saying? Like, it needs to be, thank you, market value. And you can get a little extra like we can just normally, but you know what I'm saying, it needs to be around that cost. Okay, so my home is worth $200,000. I sell it to the corporation for $200,000. It's on an installment plan, so the corporation is paying me how the corporation can pay me, right? Maybe the corporation don't have $200,000, they paying me $5,000 a month. I done moved on, I'm in my other home or whatever, but the corporation is paying me for that sale, okay? When a corporation makes money, then you take the rest of your money. We understand that part. Okay, so every asset has what's called depreciable value. Okay, it's a depreciating asset. And because now the corporation owns that property, the depreciable basis in that property increases, okay, which causes, just like a car from this perspective, you can depreciate your vehicle, right? And it becomes a tax deduction for you. Exactly, you got me? Your business. Same case in point in this scenario, okay? We have a question.
Jennifer wants to know, can a rental property be moved to the LLC / S Corp post-closing? If so, how? Or does it have to be free and clear?
Is there a loan on that property? Let me just give the scenario. She don't have to tell me. Oh, she's here. Hi. Okay, there's a loan on the property. Thank you. Okay, so first of all, the logistics of that loan, whether or not that loan is with a lender, basically. So there has to be, that has to be settled, basically. Because how can you sell it free and clear to the corporation if there is a loan on that property? Right. You good? Okay, she like, I'm trying to. Any more questions? Thank you.
Okay, so you gave the scenario about letting the company purchase the home. Mm-hmm. Can I lease a home to an S Corp because I have a mortgage on it, and so now I want to lease this out to the company. So I'm leasing maybe space or maybe the entire home.
Yes, you can. Okay. Absolutely. It still needs to be market value, but you do have some room there as well. And I think that points to, is it next? I'll just go ahead and go there without us, or not. Okay. The answer to the question is still yes. You can lease it. You can rent your home, just so you know, it's on our advantages, but you can rent your home to your company for 14 days. That's not a huge amount per year, but you can rent your company for 14 days, your home to your company for 14 days and write it off. I mean, it's a deduction. You know what I'm saying? It may not be much. It depends on what's the fair market rental value, you know what I'm saying, of properties such as yours. That's on another slide. So let's see. Any more questions on that one? Okay, so reimbursement of travel expenses. Most of us know this. You can get your travel expenses reimbursed from any company type. I suggest keeping something such as an expense report. It doesn't have to be long and drawn out. Just open an Excel spreadsheet, put your purpose of travel, where you're going, how much it costs, and attach your receipts. Okay, so you can write off, travel costs. They do look at the fact of, of course, if you're a travel agent, then you're expected to maybe have more cost than someone else. Now, I mean, you're traveling every week, and it ain't, you know what I'm saying, business related, then just be cautious, on those things as far as how much you take advantage of that. If you use your car for your company, and we're not talking about on the Schedule C, we're talking about on the LLC that has an S Corp or any other entity type over here, this way. If you use your vehicle, you can also, the company can pay you the depreciation deduction. Let me let that sink in a little bit. The company can pay you the depreciation deduction, okay? Which means if that car is depreciating at $18,000, the company can pay you for use of that vehicle the depreciation deduction, okay? Any questions on that one? Yes. Hold on 1 second, Kimmy.
Okay, how does that work for 1099?
recipients? Okay. With the 1099, are you structured in any way? And from this side over, do you maybe have a LLC that you've had?
Not yet.
Okay, so you're kind of right here?
Yes, this
Okay.
year the plan is to go to a LLC.
Okay.
But I'm looking at like the middle part maybe best for me.
Okay.
But so when I go to file my taxes,
Mm-hmm.
I use my IQ to track all my mileage.
Okay.
So at the end of the year, they give me the travel report.
Okay.
So I could use that. Like Hurler also is another app that I use to track all my expenses. So like every time I swipe one of my cards, you know, it asks like, okay, is this business or personal? So with that, that would still operate the same way as a 1099?
So, thank you for your question, first off. Because the company, of where the company lands here, you have two options as far as historical. We know you have your plans for the upcoming year and all of that. But as far as what has happened, now you have two options. You have the option of reporting your mileage like you normally do, or you have the option of the actual cost option, which means the depreciation, repairs, costs on the actual vehicle. So in that scenario, what I would do is weigh which one gives me the bigger benefit. However, I must drop this in the equation as well. If this is an existing vehicle, first of all, if the vehicle was purchased in 2021, then there are different parameters for it, okay? If the vehicle was ongoing, and let's say when you started with the vehicle, you used the depreciation method. You have to continue with the depreciation method until you put that vehicle out of service. So you don't have the option to switch to mileage. You have to stick with the depreciation because that's what you initially chose. You see what I'm saying? Because now depreciation for the first year has already taken place, and then, you know what I'm saying, it continues to depreciate until the end. So you have to stay in that cycle until that car is no longer is placed in service for your business, okay? Now, if there is 2 cars in your home, right? And let's say that car A, you used depreciation in the past, you can switch to using the other vehicle for this year, for 2021, and you can use the mileage deduction. So the first thing I would say, do I have 1 or 2 vehicles? If I have 2 vehicles, then I would look at both methods to see what's more advantageous to me, okay? Yeah, because you may have been driving for business, talking on the phone to me, asking about this, that, or the other, okay? You may have been driving to a restaurant for business. You understand? So mileage does give you some flexibility there. It does. Do we have a question before I go any further? Thank you.
Hey, so my question is, you said in the beginning with an EIN number that we should first come to a CPA as yourself and get a consultation. How often would you recommend someone who does not have much knowledge of tax business? I'm all for learning, but I'm also, hey, if an expert know if it ain't broke, don't fix it.
Right.
So how often would you recommend someone, if they were operating with an LLC S Corp, to come and meet with their CPA throughout the year before tax season preparation, just to kind of get advice on, hey, am I doing this right? Now I imagine then at my follow-up, are there different services from a CPA where some where you just say, hey, I'm going to take over, hey, we'll do consultation. Yeah, just what all offer? What all services do CPAs offer?
Okay, thank you for your question. I'm actually so glad that you brought that up in terms of how often you should talk to your CPA, your tax advisor throughout the year. I definitely recommend at least twice a year, maybe some type of 6-month period in the year. But if there are things that are in the pipeline, maybe you've signed a contract with a big client, maybe you're about to purchase a fleet of vehicles or some trucks or something like that, you want to make sure you have that consultation, that conversation to make sure we're still in line, because just like we talked about this EIN situation, and when you choose it, this is not going to be the scenario from now to forever for your company. You see what I'm saying? Like, there's going to be a time where you need to switch that classification, because now you're making a whole bunch of money. You're bringing in millions on millions on millions. Some of this stuff don't apply anymore. Now we're in another complex situation. You see what I'm saying? And that's just how, of course, taxes is. It's complex. It's very connected to basically what those financial statements are going to say. So as often as you need to, I don't really see a lot of, it depends, but I don't really see a lot of needing it more than maybe every quarter, at least. Definitely twice a year. But if you making moves and this money is coming in and you like, hey, we finna open this trust, we finna start a holding company, I'm looking at this, can I create a subsidiary to do this, or I'm finna invest in her business 20%, what's coming down the pipeline as a result of that? Because if not handled properly, now we're looking at a big tax bill. You know what I'm saying? Okay, we have another question.
If I do not have receipts, is it okay to use bank statements to report all business expenses? And should I include any other reports along with the bank statements?
Okay, thank you. And I'm going to come back to the last part of your question, Erica, because I forgot to answer that. If you do not have business receipts, then all you can use is your bank statements. But let's make a change, basically. You know what I'm saying? Like, hold on to your receipts, because if you can be selected for income audit because maybe you didn't report that 1099 that somebody sent you later. You could be selected for a random audit. There's so many different things, and they don't play about looking at, first of all, who want to give them your bank statement? I mean, you know what I'm saying? I don't want to give them my bank statement. I don't want to give you my credit card statement. I don't want to give you no statement. So yes, that's what has to happen, because 2021 is behind us. But on a go-forward basis, I would definitely say hold on to your receipts. Scan them. We got these phones that's scanning stuff. We scan it on the iPhone, upload it to a file on our system, and it connects with every device, right, that we have. That's an Apple. So I definitely would recommend that. Going back to Erica's question at the end, you asked what services the CPAs firms offer. We do offer services where we'll take it over for you. Some clients just want to come in and say, okay, hey, I got this, I can handle this part. You know what I'm saying? And others like, listen, I'm too busy working, and I'm too busy making this money in deals. I need y'all to take care of this for us. So it just depends on what's necessary. But I must say as well, if you're going to do it yourself initially, make sure you know what you're doing, okay? Because it does cost more to correct these things than get it right the first time. You know what I'm saying? So make sure you know what you're doing. Make sure you know what you're doing. Any other questions? No questions. Okay. Let's Let's see. With this type of entity type right here, LLC, sole proprietor on the Schedule C, for those of us that have or that are here or that were here, we can write off home office expenses, right? But we don't get a good deduction for it. This one right here, they pay us tax-free income, okay? That means if I have this type of entity type, and let's say my light bill is $5,000 for the year, okay? I use 20% for business. They're gonna give me how much money? 20%. That's a good one. They gonna give me 20%. That's the right answer, okay? They're gonna give me 20% cash money, not this whole point 10 or point this or point that they give you on the Schedule C just as a deduction. No. They're gonna deduct $5,000 from their financial statement, right? That's an expense for them, but they're gonna pay me. Not $5,000, but the 20% of the $5,000, and they're gonna pay me that. This applies to everything related to that home office, okay? Gas, that is some heat in that home office. There's some water in that home office. You see what I'm saying? Home office means where I'm storing equipment at. If I'm doing photography in my garage, that is a, thank you. It's a home office. Okay, so you might have 2 or 3 home offices that you do business in. Okay. So, would you say that one more time? Pastor saying, does that mean rooms throughout the house? Right, exactly. You can. So, for instance, I have 2 actual offices. There are 2 actual offices. And then there's some photography being done in some places. No. One of the offices, let me be clear. Let me really say it. Okay, he's asking, 2 different businesses. That's what he said. So that is right, if you're using it for home office. So you can write off, I got them, 2 or 3 different, he's asking, so am I saying, I originally said we can write off 2 or 3 spaces as long as it's a home office. That is correct. Some people store inventory in their home. Some people use spaces in their home for lawn machinery or equipment. You know what I'm saying? Maybe that space is there and you have an office inside the home where you conduct business. You see what I'm saying? So yeah, there could be multiple spaces inside of the home. Right. Okay. You got a question? Okay, no question. Let's see. Okay, we have a question coming to the front.
Hello, my question is, when you're saying 2 offices, let's say I'm doing catering or doing food. So my office is in a room where I do all my billing. I have a desk. I have all that set up where I do my billing. But then in another room, I have where I have my products, my pots, my pans, my inventory. Would that be considered one office since it's the same thing in 2 different rooms, or what? How would you classify that?
That would be, both spaces would be considered your home office.
Just my home office? Okay.
Yes, both spaces combined.
Okay.
You see what I'm saying?
That's what I need to know. Thank you.
You're welcome. Any additional questions? Another one is if you have if you are conducting business on cards as well, then you can write off the interest, of course, as well as anything that's being financed. If you are financing a vehicle, then the interest on that car loan can also be deductible. Okay, we're ready for your question.
Awesome.
Thank you.
So you know how you always hear people say like, I'm gonna just write this off. I'm gonna write this off. And since we're on this topic of business tax advantages, I've also heard, and this is like through casual internet scrolling, you know, people say you don't always want to write everything off because like sometimes you need a certain amount of revenue to be eligible for certain grants. So where do you start to even draw the line? Do you hit the maximum of what the IRS says? This is your total deduction. Is that the goal for the year to, I guess, write things off? Or do you want to hit that maximum they give you, or do you want to stay below that? And I know this is kind of really a case-by-case scenario, but what is an optimal situation, if you're speaking real general, of just being eligible for certain city, state, federal grants, of what you classify as, and still maximize, I guess, your tax deductions?
That is, like you said, on a case-by-case basis. The goal is to be profitable. You know, the goal is the gross revenue, to bring that in. That's really the bottom line of where we want to get. Yeah, sometimes we start off and, you know, we have these losses and stuff of that nature, but the goal is to grow, right? So that's number one. Number two, you write off your deductions based upon if they exist. You know what I mean? Like if you have them, you write them off. Now there may be times when you want to pull back because, like we said earlier, you're looking at purchasing a home or something of that nature. What we saw hit with the pandemic for businesses and the SBA loans and all of that stuff, people were not reporting before this. So now when you apply for the EIDL or other SBA loans, they want your 4506T form, which pushes back to what have you filed with your tax return historically. So that gets into situations where we may be banking when it comes to stylists or people that accept a lot of cash, or, you know, those types of transactions. However, when these opportunities come, it's hard to get that because nothing has been reported, or something very small has been reported. So they're basing off your gross margin, which is your revenue minus your cost. Not your expenses, but your cost. So if you don't have anything right there, then they're only saying, hey, we're going to offer you $10,000 or we're going to offer you $1,000. You see what I'm saying? So that caught us off guard. You know what I'm saying? Well, none of us knew the pandemic was coming. You know what I'm saying? So nobody, you know, you couldn't account for that to say, okay, in 2 years they are going to be offering this, so I need to be in that position. You see what I'm saying? So yeah, the goal once again is to drive the revenue at the top and report the expenses up until, you know, sometimes once again you have to pull back on it. But if you're in the market for lending, they want to see a certain level. Depends on what you're trying to get. You know what I'm saying? Like, you can't be, and now let's just talk about it. It's not off subject, but it's a little bit over there with this whole Zelle situation and this whole Cash App, the third party, and the third party sources are going to be reporting to the IRS what has come through those things. You know what I'm saying? Like, so now we gonna go to all cash and not report? You know what I'm saying? Because the IRS knows this is what's happening. We're pushing back. You see what I'm saying? We're not pulling, you know, showing everything, you know. Yes, we have a question.
Is using a bedroom an office?
That's a good question, huh? Right, this is what I'm thinking. Pastor said the line of work. Oh my God. I'm sorry, you said it though. I know, I really don't. Thank you for your question. But my mind did wander just a little bit, but I'm back. So, because home office is based upon the square footage of the home, then we would have to do some type of percentage of that room to use as a home office, right? Because at least in my mind, I can't think of a scenario where the whole room would be 100% office use the whole time. But it can. So the answer to that is yes. Okay, I am moving away, but yes, thank you for your question. The answer to that is yes, it can, just a percentage. Okay, we have another question.
Okay, I have a question, kind of piggybacking off Erica and your services. So I do understand that you are a CPA firm. Would the best type of customer for you be one that kind of has a business plan together to know where they're going, to kind of like answer her question and piggyback off that, you know, like, do I report everything? What if I need to purchase everything? Would the best customer for you be, you know, in a perfect scenario, a customer that has a business plan, know what they're trying to accomplish that year? Because maybe will that drive where your taxes need to be that year or the next year?
So I wouldn't say that. The answer to that in regards to having a business plan is yes. Having a thorough 25-page plan, no. Because sometimes, you know, we'll get caught up and then we won't ever execute. You know what I'm saying? So I wouldn't necessarily say in a perfect world what it would be, because we help clients that are just getting off the ground to clients that's been established and are, you know, $20-50 million revenue every year. You know what I'm saying? So I think if it's a business that is a startup business, then they need to be serious about it. You know what I'm saying? Like, they need to be ready to go, you know, to pull the trigger on things. You know what I'm saying? I guess just not, oh, hypothetically, if this happened, that happened, all of that stuff. You know, you're ready to get started. That's when I would say, because you're going to be paying money. So you don't want to be spending money and you spending wheels. You really don't intend on doing anything. You know what I'm saying? But we can help from all levels, and we have help from all levels. So, yeah. So, is there any more questions? Time is upon us. I have enjoyed you guys. Yes, we have another question.
Hi.
Hello.
Can you explain, or a little more in detail, you hear people say they're going to lease their car through their business. So are there any like pre-qualifications, and like, is there like an actual hard copy? Like, how does that process work and the advantages of it?
They're going to lease their car through their business.
To themselves.
To themselves through their business. If you're going to do that, I would definitely say draft some type of agreement. You know what I'm saying? You need that, because if ever questioned, you don't just want to be, you know, oh, this is what I decided to do. It needs to go ahead and be in writing. I would get it notarized and go through all of those procedures. Yes. So that's what I would do. What was the end of that question? Tax advantages of leasing the car to yourself. So if So basically, if the company purchased the vehicle, the company can then write off the depreciation deductions for that vehicle and other costs, actual costs of that vehicle, happens with that vehicle. If it then leases, so that's one deduction. If it leases it to, let's say, one of the owners, there will have to be another business in place, meaning that owner can write off those deductions on its tax return if there's another business in play. Do you see what I'm saying? Because you're already getting the depreciation deduction over here, so there must be another entity that's getting the lease write-offs. Okay, because you can't just take advantage of lease write-offs without having a company. So there has to be a company that's taking advantage of those write-offs. Okay, so it's really on both sides. Thank you for your question. Anything else? Okay, well, I have enjoyed you all. Thank you so much. Yes, thank you for your attentiveness. Thank you.
Let's give her another hand clap. I want to thank everybody for your attentiveness and being interactive. Those were some awesome questions, and hopefully a lot of information was gained. If you want to reach out to Olympia, you may do so. Did you have your information? She has cards that she will pass out if you are interested in a consultation and her services. She can also be found on Facebook and Instagram.
And my website is www.olympiacpafarm.com. Right on the board.
And we will try to also put it in the chat as well. Also, we have coming up next week, we have credit. So if we need, I see some hands going up. So if you need help with building your credit, correcting some things on your credit, general credit questions, please come with the same energy for questions for Mr. Lawrence on next week. I want to also apologize. I know we did have a slight issue with the link. However, you will be able to rewatch the link from beginning to end. So if you have registered, you will have access to still watch the link from tonight from beginning to end. And please do not forget to sign up for next week. All right? Thank you so much. Y'all have a great evening.